Welcome back to our video on leverage in Forex trading. In this section, we'll be discussing the benefits and risks of using leverage. One of the biggest benefits of using leverage is the ability to trade larger positions with less capital. This means that traders can potentially make larger profits from smaller investments. Additionally, leverage can also make it easier to open and close positions quickly, allowing for greater flexibility in trading strategies. However, it's important to remember that leverage also carries significant risks. Since leverage amplifies both gains and losses, even small movements in the market can result in significant losses. This is why traders must always have a solid understanding of risk management and use leverage wisely. In addition, leverage can also lead to margin calls, where the trader is required to add more funds to their account in order to maintain their open positions. This can be especially dangerous if a trader is using a high degree of leverage and is not adequately prepared for potential losses. In the next section, we'll be discussing different types of leverage and how to choose the right. We'll be discussing different types of leverage and how to choose the right one for your trading strategy. There are two main types of leverage that traders can use in Forex trading: standard leverage and high leverage. Standard leverage typically ranges from 1 to 1 to 50 to 1, while high leverage can be as much as 1,000 to 1 or more. The choice of leverage depends on your trading goals, risk tolerance, and the market conditions. Traders who are new to Forex trading or have a low risk tolerance may want to start with lower leverage ratios to minimize potential losses. On the other hand, more experienced traders who are comfortable with higher levels of risk may prefer to use higher leverage ratios to potentially increase their profits. When choosing the right leverage for your trading strategy, it's important to consider factors such as your trading style, account size, and the volatility of the market you're trading in. You should also make sure to have a solid understanding of the margin requirements and risk management strategies that come with using leverage. In the next section, we'll be discussing how to calculate the margin and leverage ratio in Forex trading. We'll be discussing how to calculate the margin and leverage ratio in Forex trading. Margin refers to the amount of funds required to open and maintain a position in the Forex market. It's typically expressed as a percentage of the total trade size, and the required margin can vary depending on the currency pair and the broker. The leverage ratio, on the other hand, refers to the amount of leverage provided by the broker. It's typically expressed as a ratio, such as 50 to 1, which means that for every $1 of capital, the trader can control $50 in currency. To calculate the margin required for a specific trade, traders need to multiply the trade size by the margin percentage set by their broker. For example, if a trader wants to open a position of 100,000 units of US dollar to Japanese yen with a margin requirement of 2%, the required margin would be $2,000. To calculate the leverage ratio, traders need to divide the total trade size by their available capital. For example, if a trader has $5,000 in capital and wants to control a position of 100,000 units of US dollar to Japanese yen, the leverage ratio would be 20 to 1. It's important for traders to have a solid understanding of margin and leverage calculations in order to manage their risk and avoid margin calls. In the next section, we'll be discussing common mistakes to avoid when using leverage in Forex trading. Thanks for watching.